Meanwhile, Canadian stocks hitting another all-time high in early trading today after a record high yesterday. And that, of course, as some of the fears start to wane in these markets, that turns our attention back to valuation questions. Noah Blackstein is Vice President and Senior Portfolio Manager at Dynamic Funds. Great to have you with us.
Thanks, Amanda. Nice to be here.
Let's talk valuation, because we've got markets near record highs, very long in the tooth, right, in terms of how long the bull run has gone. What are you watching? What do you think when you're thinking about fundamentals underpinning the values?
Well, I mean, we did have a pretty close to a 20% correction in the fourth quarter of 2018.
Yep.
I think last year was a year, though, where we saw the markets really perform dramatically last year, but more so the earnings were down last year for the S&P 500 in total. And a lot of the best performing stocks in the latter half of 2019 had down revenue and down earnings. Mm-hmm. So for the market to work this year, I think or individual stocks to work, certainly, the earnings sort of have to catch up to that price performance that we saw. And so I think this is a year where the earnings are going to matter even more so, for sure, because we priced in 2019 a lot of a recovery in earnings for a lot of cyclical stocks. And, you know, I think there's a few things to say, well, even if the earnings come through, maybe some of those stocks pause. Mm-hmm. My focus is usually on growth companies, more secular growth stories, for sure.
Yep.
But I'm fairly comfortable with the growth outlooks and the valuation, for sure. But there are other pockets that need to deliver.
We do have these kind of unexpected headwinds. And coronavirus, we have yet to really fully know how long does it last, what do the closures mean, are supply chains disrupted? I mean, there are things we'll start to measure in the weeks ahead. When it comes to some of the sectors that you invest in, are you starting to worry, or are they kind of insulated from some of those trends?
I don't think they're insulated. I mean, like, China is shut down here. Mm-hmm. There are definitely supply chain issues that we're hearing about. And there's going to be demand issues when you lock up that many number of people in their homes. Mm-hmm. In China. It's obviously going to be a demand hit. The question is, does the market look through it, as in we know we're going to have a hit in the first quarter and second quarter because of the corona and it was a one-time thing and we go through it, or how does the Chinese economy recover out of this? Those are still unknowns for sure. And so we don't know some of those questions. It was unexpected, but if I think about all the things that we've dealt with over the last, I've been running the same fund now for over, I guess July will be 22 years. Right. So the biggest concerns for me center around the Federal Reserve. There hasn't been a huge market break that they haven't been instrumental in causing, as far as I'm concerned. And so, in 18 we were sitting here and they're talking about 4 rate hikes in 2019. And they cut 3 times. They're talking about running off the balance sheet, and they added $500 billion in the fourth quarter. So the reality is, in terms of central banks, they're out of the picture in 2020. They're not going to be raising interest rates. They're going to be trying to fix whatever has happened in the repo markets, including expanding the balance sheet. And I think from a risk perspective, that always has a much more dramatic impact on markets than some of these other things. Certainly, they're devastating to people living in these cities and family members, but the market kind of moves on forward from these things.
So when you take the Federal Reserve out of the equation, which means, of course, continued kind of expansionary monetary policy, if standing
certainly
still.
Not contractionary, which is where they were doing.
But in a way, standing still is expansionary based on where the Fed is right now. They're not going to lower rates.
Correct.
They've got a massive balance sheet. They are going to do some work on the repo side. Where does that put you in terms of sectors you're watching, or even size of company that benefits from that kind of activity? Well,
some of the areas that we've focused on historically and are continuing to focus on are more of the secular growth trends. So whether it's in healthcare and technology, you really have this replatforming of enterprises, this digital transformation of companies. We talked a lot about the movement to the cloud for standalone apps, whether it was customer relationship management or your human resource type of software. But now we're getting into a part of this curve where of the $1.7 or $1.8 trillion spent on technology, only about $160 billion right now is cloud. And what companies are beginning to realize is, if you look at the success of a Google or a Facebook or an Amazon, now more and more enterprises are saying, we sit on so much customer data. If I go out this afternoon and buy a short sleeve shirt and a bathing suit, I should, whoever I use, whatever credit card I used, I should be getting an email offering me a travel rewards visa, or maybe travel insurance because OHIP might not cover you out of the country, et cetera, et cetera.
Right.
The ability to mine your existing customers' data for a second sale, that really hasn't happened for a lot of enterprises. Most businesses have viewed their technology spend as compliance or processes or cost. None of them have looked at it as a revenue generator. And that leg is just sort of beginning to unfold here, and it's exciting.
So what could interrupt the secular growth trends that you hope to see?
Well, I mean, recessions will always interrupt them.
What could cause a recession, I guess, is what I mean.
Well, typically, if we haven't really had a recession that's been a classical economic recession, which is too much supply, not enough demand, and we fall into that type of mode.
Yep.
We've consistently had for the last 25 years of my career a recession that's typically been caused by central banks raising interest rates too far. Whether that was the 94 peso crisis, 97 Russian debt default, long-term capital 98, 02 to 00 to 02. I mean, this has always been not observing the signs in the economy and continuing to raise interest rates and causing a huge break.
Right.
So I don't think that in the next recession, though, just as we never went back to Blockbuster and we use Netflix, we're not going to be going back to desktop PCs and on-premise software.
Right.
These secular trends will continue. Will they be hit in a recession? Of course. But we're not going backwards in time.
So we've only got about 30 seconds here. One of the things you're good at is proofing your portfolios against the downside. What are you thinking about when it comes to that, given where we are in the markets, how lofty valuations are?
I think, in terms of, for me, in terms of protecting the downside, I think it's really about knowing your companies. So I don't think you should be in the equity markets if you need the money in a year or two.
Right.
And then, you're going to have to be able to withstand some volatility in terms of the equity markets. They're not for the safe investor. I think a lot of investors who are bond market investors have been driven into the stock market believing that a dividend yield is the same as a bond yield and there's no volatility in those stocks. I would say the equity market is not for that. It's for, return on capital, not return of capital. Yeah. And I think if you know your companies well enough and you can ride through the volatility, that becomes the more important part for the secular growers, for sure. And how investors should think about the equity market, not as a bond substitute.
It's great to have you.
Nice to see you again.
Noah Blackstein is Vice President and Senior Portfolio Manager at Dynamic Funds.